everyone, and welcome to today's webinar, Essential Property Tax Compliance Considerations During Mergers and Acquisitions. My name is Ashley, and I'll be your host for today's webinar. Today, we are covering the typical property tax compliance cycle and cadence, how mergers and acquisitions impact the property tax compliance cycle, how to determine new filing requirements, reporting changes after mergers and acquisitions, and audits. But before we dive into all of that, I do have some housekeeping items to go over. First, just a friendly reminder that Avalara cannot provide legal tax advice, but we will answer your questions as best we can. On your screen is our safe harbor policy. Please take a moment to review that while I continue with some additional housekeeping. We are recording today's event, so if you want to listen to it again or share it with a colleague, you'll receive the recording later today. The console you're looking at can be customized, so feel free to move or resize the windows. The slides can be resized by dragging the bottom corner, and you can download a PDF version of the slide deck under Additional Resources. That Additional Resources section also contains some related resources, so go ahead and check those out. There are several ways to engage with presenters and your fellow attendees. First, if you have any questions, you can submit them using the Ask a Question box. We will save time at the end for Q&A. You can also submit any troubleshooting questions in that Ask a Question box. Second, you can join our attendee chat. You can click the icon along the bottom of your screen with the two chat bubbles, and the attendee chat will appear. We encourage you to introduce yourself, network, and discuss today's topic with fellow attendees there. Third, you can react to the presentation by clicking on the emoji icon and reacting. And as presenters, we can see what your emoji reactions are. And if you have any technical issues, there is a question mark icon along the bottom with suggestions, or you can reach out using the Ask a Question box, and we'll try and help you out. And just a note, if you've attended webinars in the past, we typically have our webcams on, but we do not today. So if you're looking for our faces, they are intentionally not there. All right, I am excited to announce that Avalara's signature customer event, Crush, is coming to Austin in November, and we would love to see all of our customers there. You can join us for 3 days packed with interactive sessions, thought leadership, networking opportunities. You'll learn how to get the most out of Avalara solutions, build connections, and have some fun too. So the earlier you register, the more you save on the event. So you can check it out at avalaracrush.com. We are offering 1 CPE credit for today's presentation. For those looking to receive CPE credit, please note that we will ask you to respond to 3 of our 4 poll questions. The poll questions will pop up on your screen for a limited amount of time, so please make sure you're ready to answer when that question appears. Please do not split or tile screens on your computer, as this can affect the placement and where you see the poll question. And then you must attend the full duration of the webinar. Once you have met those requirements, your certificate will be available to download in the Earn Certification box on your screen. You'll click the little icon to access it, and it'll pop up in a new tab. You'll also receive the certificate in a post-event email later today. Unfortunately, we are unable to provide CPE credit to those who have technology issues that prevent you from qualifying. So if you have any issues, please reach out as soon as possible using the Ask a Question box so we can help you out. Now let's meet our presenter. Today we are joined by Melissa, Senior Sales Executive at Avalara. Melissa, can you take a moment to introduce yourself?
Sure. Hi, everybody. My name is Melissa Shad, and I come to you with about 20 years of property tax technology experience. So going to share some of the insights that I've gained over the years that I've been in the industry.
Great. Thanks, Melissa. And before I hand it over, we are going to get to today's CPE poll question. So you should see that appearing on your screen now. And the question is, how would you rate your current property tax compliance process? Great, good, average, poor, or terrible? So we'll give you all some time to respond to that. And just as a reminder, you do need to answer 3 of these 4 poll questions to earn CPE credit for today. We'll give you maybe 10 or 15 more seconds to pick your response and submit. Okay, let's look at the results. So, looks like people are feeling average to good about their current process. So let's see if we can get them to great during this presentation. Melissa, I will pass it back over to you.
Thank you, Ashley. So what our agenda is for today is the property tax challenge, which there's a lot of them, property tax cycle, which is going to impact, everything to do with an M&A because the cycle is ongoing. So you don't really have that break in the traffic to just stop and deal with it. It's all going on as you're doing the M&A. So we're going to go over 6 property tax to do during an M&A, how Avalara property tax can help, and then any questions that you guys might have. So the property tax challenge, just in terms of mergers and acquisitions, there's obviously a lot of different factors that go into it. We're focused on property tax today. But when we're looking at, what is real versus what is personal, there's going to be obviously some distinctions that need to be made because of reporting. One of the things that we want to talk about is, when you are merging, when you are acquiring, and we're going to kind of look at this a little bit more from the, the acquiring company's perspective, because you're going to be the one taking the majority of those obligations. But if you are being acquired, then that's obviously something you need to be able to provide all of this information and then make sure it matches up. Because one of the things that we look at a lot is, there's a lot of ways to code property. And so there's some things that people want to put as real and not have to report on a return. They want it valued differently. So real property being, your land and buildings. But there's some gray area in there in terms of what is considered real property, like how attached or affixed is it. And then your personal property with movable assets, which is going to be a big deal during a merger or acquisition because, again, the acquiring company is going to want to make sure that the company you're merging with or purchasing has all of that information. That data is really critical because if there's a lot of property that you don't actually know anything about that you then become out of compliance with, something that's important to know. And obviously, those aren't always going to be the people that are making the deal. Those are going to be the people that are in the tax department that are, the hands-on users or the hands-on people that are going to know kind of where all of that information is and if it's in any sort of, structured fashion, because people have certainly provided all sorts of different spreadsheets and, we cobble it together with this and that, and it just becomes kind of a nightmare. So thinking about, where that data is housed and how you get all of it together prior to, a merger or acquisition. When we talk about financials, just in terms of property tax, there's different rules in different jurisdictions, as far as supplies, inventory, taxability, vehicles, things like that. And so property tax being part of the cost of doing business, and that's going to impact your EBITDA. The size of the property tax relative to your net income is also something that, you obviously want to be looking at when you're looking at a merger or an acquisition, because obviously the financials have to make sense. And, sometimes people are hiding dirty little secrets on their financials that don't come out until you really start, doing some of that, forensic accounting and taking a look through some of those things. So looking at bringing tax liability down, how is that going to be done? How is that currently being done? And is it being done in a way that the acquiring company is okay with? Different companies have different cultures. Different companies have different standards. We'd like to think that there's, across the board standards for accounting, of course. But you guys have probably all worked at different organizations that had sort of different thresholds or different, we're going to do it this way, but another company might do it differently. And some of it is relative, some of it isn't. But making sure that, each company is kind of in line, because if you're not, then how the acquiring, company is doing something is going to be very different potentially than the company that you're merging with or that you're purchasing, the target company. And so there may be a lot of shifting of those numbers or of how things are being reported or depreciated that is going to change these numbers quite a bit. And that is one of the things that, we do want to talk about in terms of financials is reserves. It's certainly important with business licensing when you're doing an M&A, and it's very important when you're doing, an M&A for property tax to have those reserves available, because there are going to be costs, there are going to be things that come up that you did not prepare for. And so you want to have that money in reserve. Also, thinking about your solutions, like SaaS solutions that you may have, that you may pay a lot of money for, your different software vendors and software products, they may not even show up as an asset, but that still is a cost and something that's, impacting your bottom line there. So again, or the company that so tax can make a difference in that. Is that going to be something that's going to, really help you or hurt you when you're thinking about a bonus structure for either your locations or for yourselves? So, lots of different areas to look at in terms of financials, because assessors might just be looking at cost. They might be looking at your depreciated value. They may take your depreciated value. They may not care what you think your depreciated value is. But if you don't know your value and you don't compare it to what the assessor is assessing, you could be significantly overpaying. And we see a lot of organizations that are doing that. They don't really pay attention to their assessment notices. And so that's important when you're purchasing a company or merging with a company to identify if that's something that they've been paying attention to, and is there potentially a way to lower that tax liability during that process. When we think about compliance in general, and we're thinking about, okay, we're doing a merger, we're doing an acquisition, all of these pieces are going on during that time as that's going on. So it's going to be important in terms of timing how that compliance gets transferred over. And again, it could be that both companies are staying intact and, maybe you're keeping both teams for a while. It could be that, everybody just got fired from the company that's being acquired, and the tax team in the parent company or the acquiring company is now suddenly having to take on all the returns, assessment, bills, and documents for the company that's just been acquired or just been merged if they've kind of winked out of existence. So, knowing what's going to be coming due, if that organization has, different jurisdictions that you're looking for, those are all going to be important things as this compliance cycle is happening. So that's got to be part of the plan. And I got to say, it rarely is. When people are making these deals, they're not thinking about, down to the wire deadlines and things like that. They're kind of doing that up in the executive level. And, you guys who are often the ones that are actually having to do the work at the last minute or finding out at the last minute, oh, this new company has property in jurisdictions we didn't know about, or they had appeals going on that we didn't know about, or they were getting abatements that no longer exist, which we'll talk about further. Those are things that are going to make your jobs a lot more challenging if those things aren't planned for. And sometimes even, deciding when you are going to do the merger, there are times that are certainly better than others for a tax department to have this happening. So those are some things that, we also want you to be aware of and, potentially try to bubble up to the people that have the decision-making ability to find out what's happening. So within the property tax cycle, we talked about, your bills, your returns, your notices, appeals and audits that are going on potentially at either one of the companies, the parent company, the target company, and payments. But also underneath all of that is the planning, the strategy, the taxability analysis, comparing what's been done in the past to what's going to be done in the future if there's any discrepancies between the two organizations. Also, which company or do both companies have appraisal and valuation report, have expert witnesses, things like that for appeals. And if one has them and the other doesn't, you certainly want to be able to leverage that versus, again, sometimes with, a merger or an acquisition, key people kind of just get dropped off the radar because the jobs become redundant. And then you're losing, a lot of resources or a lot of knowledge of who the resources are or were in the past. So thinking about how that's going to happen, especially for different jurisdictions that you may be in. You as the acquiring company may be really well versed in the states that you file in. And then, I've seen this happen many times where somebody wants to, buy a company that's really well versed in the jurisdictions that they're in a different region. And those people get let go, and all of a sudden everybody's having to do stuff in jurisdictions that they have no idea how they work. They don't have any contacts. They don't have any resources. And it just becomes kind of a mad scramble. So planning for all of this as part of that, merger and part of that acquisition is also something to consider. And I am going to touch on this a little bit more later, but I would say that if there's any big merger or acquisition going on, it is something that is highly recommended to use a firm that is expert in mergers and acquisitions. There are always consultants. There are many firms that do it. There's some on this call that, are great at it, but you do want to think about, there's going to be things you don't know. Even if you've gone through it before, there's going to be people that are going to be able to help with that. So just as far as, you may be going through the whole cycle, up at the top, but you want to have experts kind of helping with the things kind of at the bottom if that's not your forte. So we talked about, some of the compliance pieces, then layering in the M&A piece, determining filing requirements in new jurisdictions. So companies that I've seen in the past that have, have merged or been acquired, they may be, operating in jurisdictions that the parent company doesn't operate in. And there are different filing requirements. There are different billing things that happen in those jurisdictions. Sometimes it may change what you're already doing also. So keep in mind, even if you're already filing in a certain jurisdiction, then, you may be under a threshold somewhere, but now that you've acquired this other company, depending on how the merger or the acquisition is going to be structured, is it going to be two separate companies and, operating independently, so they're both falling under the threshold, or is it being reported as combined property now? If it's fully owned by the acquiring company, that can obviously make a difference in terms of your filing requirements. So those are some things to consider when you're looking at where this, the new company is going to be operating. And are you familiar with it? Do you know what to do there? Do you know what might be changing there? Keeping existing exemptions and abatements and looking for opportunities. So this happens a lot. A company might, have, an exemption or an abatement somewhere because, again, they fall under, a certain headcount, or they, fall under a certain industry. And now you're being acquired by a company that no longer has that, has those requirements met. So then you lose those exemptions and abatements that you were expecting, or the parent company was expecting, not realizing that that's going to change. So also on the flip side of that, maybe now you suddenly, qualify for some of these things because now you're, in different areas, or you're, acquiring a company that has environmental exemptions or abatements in different places or things like that. So again, just being really aware of what's available there. And again, if that's not your forte, I would highly recommend using a consultant for that, just to make sure you're really maximizing what you could be doing with your, tax savings. Bill accounts are huge because it could be that, a collector is going to collapse, all the property within their jurisdiction for both companies into one account. It could be that they're going to keep different accounts. It could be, done a number of different ways. And also, the administration piece of it, which we'll talk more about later. But making sure that all of those accounts are tracked so you know that you're not missing any bills for either, the parent company and then the acquired company or target company. You don't want to slip bills. You don't want to not pay on time because you weren't aware of an account that you had, or you weren't aware of property being in certain jurisdictions. So you don't want to, hit up those penalties and late fees, which certainly can be very pricey. So as those, reserves I mentioned earlier come into play, that's one of the reasons why, because it's rare that somebody doesn't flip something during a merger or acquisition. Administrative pieces, legal entity, mailing address, signatory changes should be made and tracked. And I'll give you some examples of those later. But if any of you have ever been through a merger or acquisition, you know that, people are still sending bills to the old address 2-3 years later. So again, tracking what you're getting, what you're not getting at the new address is crucial, because you may have to track it down if they're still mailing it to the wrong place. And then again, auditing all of the locations, the assets, how you're doing your costs, how you're valuing, is important because, again, it's tedious, but it's important because you want to make sure everything's in line and reported with parent company standards. And then reviewing your valuation post-reporting, identifying appeal opportunities, and then if you have open appeals or existing audits, how are those going to get transferred to the new structure, and who's going to be in charge of that? Because again, often when these things happen, there are staff that are lost, and we all have had that situation where so-and-so is let go, or so-and-so decides to leave, and then that's the only person that knew how to do XYZ or knew where these documents were kept or any of that. And now you're kind of scrambling. So that's not something you obviously want to happen.
All right. Thanks, Melissa. It is time for our second CPE poll question. So our second question should be up on your screen. It should be in a little pop-up window, and it is, how automated are your current property tax compliance processes? And we have options from extremely automated to not at all automated. So you can select your answer and hit submit. And just as a reminder, if you missed my intro, you are looking for CPE credit, you do need to answer 3 of these 4 CPE poll questions and then attend at least 50 minutes of this webinar. And this is our second poll question. So we'll give everyone just a few more moments to make sure they get their answer in. Okay, let's take a look at the poll results. So I would say for the most part, people are feeling not automated or just slightly automated. Any surprises with these results, Melissa?
No, not really. I definitely can see some folks on the attendee list that I'm familiar with the companies and stuff. And I think that everybody has some solutions in place. I don't think there, unfortunately, with property tax is a way to completely automate it, just specifically because of the jurisdictions being paper-based still. But it is good to know that everybody has a little bit of room, at least a little bit of room to improve some of those processes. And I'll talk a little bit more about why that can be really important as we go through.
Great. Thanks. I will hand it back over to you.
All right. So now we're going to talk about 6 property tax to-dos, and of course we've collapsed them because there's probably 109,000 things to do during a merger and acquisition. But we kind of toned it down to a few. So determining filing requirements in new jurisdictions. So this is one of the pieces that we mentioned. Target company may have property in different jurisdictions than the acquiring company is familiar with, or different types of property like inventory, supplies, vehicles, things like that the acquiring company may not own. And there may be different thresholds of filings in new jurisdictions. So one of the important pieces of this, when you're thinking about, okay, we're going to be acquiring this company, is where do you have all of your locations? How do we know what all your locations are? Because between the fixed asset system, between the real estate people, sometimes I've seen, spreadsheets coming in from every single one of the locations that they just send in a spreadsheet of what they have, and the property tax team has to kind of, assemble forces and get that all together into some sort of, cognizant piece of data that they can use to report. So if you're running along and you have your processes down and you've got everything, with your locations in, some sort of system, you want to find out if the other company does too. Because again, you want to make sure that you have a proper listing of all of the jurisdictions and all of the locations that they're in. And if they're using, a software application or something like that, that's going to be a lot easier if they've been maintaining that and, they can just drop a list out to you guys. But if they haven't been and they sort of, again, have to piecemeal this together with, a bunch of different spreadsheets, or, maybe the real estate department is acquiring, 20 new properties and nobody knows that because they haven't told anyone. We see all kinds of stuff, right, you guys? So determining these is going to make the whole property tax compliance process a lot easier, because getting ahead of that is going to help you when you're looking at how does this compare to your current reporting responsibilities, and do you need to file in new jurisdictions you haven't filed in before, and also what some of those rules and requirements may be. So getting those property listings is really critical. And again, if somebody has a software application, and I know a lot of people on the call do have, at least some sort of property tax software, that will make that much easier if, you're asking them for a listing and they can just pull it out. If that's not the case because, they're using a whole bunch of different, systems, or, they're just not really sure what's going on with other departments in their current organization, that could be something that you really want to try to dig into a little bit more before that happens. When we look at U.S. property tax by state, we did have 38 states that were assessing personal property at a local level, down to 37 now with Wisconsin not doing that. But there's different types of state assessments that happen for different types of companies and different types of industries. So all of this is going to, potentially shake up what you're doing if you're acquiring a company that is not totally the same as your current company. We see this quite a bit where somebody will, acquire a company that's sort of in the same line of business, but not totally. And then it becomes a real difference in terms of the requirements that are needed for that new company. So tax rates on this little chart, the darker the color, the worse the tax rates are. So that's something to be aware of because, again, if you're acquiring a company that's in some of these states and jurisdictions that you don't currently file in, that can really make your workload go up quite a bit. It could, increase your tax quite a bit just because the rates aren't that great. Personal property being defined as real property in some states and, vice versa. Those can also affect, the bottom line in terms of how, your filing is done and how those, values, appeals, things like that are going to affect, again, your workload and what you need to be looking at. And I know most of you in tax departments are used to kind of getting some of these things sort of dumped on you because, people don't always think about, involving the tax department with some of these decisions or thinking about, what do we need to know ahead of the game? But the more that you can be involved in the process earlier, the better, certainly. Abatements and exemptions. So that is definitely something to be aware of, that if there are existing agreements, somebody got like some sort of sweet deal grandfathered into some jurisdiction, that's fantastic. But if the acquisition is going to void that, then that's something, again, that you need to be aware of because that's going to potentially change tax liability quite a bit in those locations, particularly if it's real property, any sort of agreements that were made. Sometimes those agreements get made, based on the company. Sometimes it's based on the industry. Sometimes, it's a lot of different things. So it's important to be aware of what's out there. And when you're acquiring another company, finding out if they have any of those things in place that the acquisition is going to affect, or if acquiring them is going to affect anything you have in place, is also important. So this is another one of those things where, when we talked about automation, whether you have a property tax software that's tracking those abatements and exemptions, or you have an exemption certificate or a certificate management system where you have those exemption certificates or you're tracking exemptions and abatements in that kind of software, you will know then what's already there. And then also seeking out what might be something that could be agreed to, what could be a new agreement. If you're, increasing a footprint in a jurisdiction, could you, try to make some sort of, case for an exemption for that or something like that. So the target company may qualify the parent for new exemption and abatement opportunities. So that's definitely something to look into. And again, having some sort of, tracking of where those are already is going to be super helpful. If you don't have it now, it's certainly important to probably start tracking that so that you have some sort of idea of what's out there and what's going to be impacted by a change. And then if you are totally lost as to any of those things, it would certainly be a good idea to hit up a consulting firm who specialize in knowing those things and being able to, try to maximize your ability to gain those so that you can save money on tax. Ensuring bill accounts, tracking, and new accounts are updated. So this is one of the biggest things that I see as kind of a cluster technology-wise when people do merge, because trying to figure out, let's say you have property, in where I am, San Diego County, and your parent or your new company or target company also does. Well, if you're reporting them as two separate legal entities, the assessor and the collector are probably going to keep them as two separate filings, two separate billing accounts, things like that. But if you're fully acquiring and that new company is going to be, completely merged into, your company, and that's going to change the legal ownership of all of the property, then those assessors and collectors may just add that property into the existing account that you may have. So that's something to be aware of, that all of that property potentially will be reported as new property in that jurisdiction because it's new to you. And even though it may not be a brand new acquisition or a brand new item, it's something that you may still have to report as new into that jurisdiction so the assessor can see it. And then when you get that bill, is it going to include all of that property, or again, is it going to be split into multiple accounts? This is really important because if there are multiple accounts, then there's going to be multiple bills. And so if you miss paying a bill because you think you paid the bill on your account, but the new company had a different account and they're still sending a bill under that old account number to the old address, even though you reported the new address, it's still going to be on you when that bill doesn't get paid. And then that's where the penalties and interest can build. And depending on the amount of tax that you're paying, the penalty and interest can be high. Again, this is where you hopefully have some sort of system or an application where you're keeping up to date with your assessor accounts, your parcels, and your collector accounts for the bills to make sure that you have a mechanism in place to identify what's missing and what's been received. If you are then acquiring a company, you need to have a listing of all of what they have in terms of the accounts. So not just the assets and all that, but what accounts are they grouped into, and then thinking about how that's going to either get folded into your existing accounts or stay separate accounts that you now need to track. So again, that automation and that process of being able to track that, being able to get that easily from the company that you're acquiring is going to be a lot better than trying to go jurisdiction to jurisdiction and figure out kind of what they're doing with it. Reporting changes to jurisdictions. So, you do your best with this, obviously. So just thinking about the property tax cycle. So when you do a new return for, again, even if it's staying the same legal entity, or, you're the parent company, but they're going to DBA as, the current legal entity, or whatever the case may be, you're probably going to want to indicate that to the assessor. So you may want to be putting a cover letter on your returns packages. Again, if you have the ability to automate that, because you're using a software that you have the ability to add custom cover letters and things like that to your returns packages, that's going to make your life a lot easier than printing out a whole bunch of them and then just sticking them into each of the packages. But of course, communicating what the change has been to the assessor, address changes, legal entity changes, things like that are going to be important. And again, we're not even touching on all of the other pieces of compliance that involve legal entity changes and that sort of thing. But step one, when you're thinking about filing new returns, you're going to be filing and you want to communicate that data to the assessors. How is your legal entity structured? So when they're doing that merger or that acquisition, are the parent and target companies going to be on separate returns? Are they going to be totally separate companies? Is one absorbing the other completely? Is there going to be a DBA? And then again, in your software, if you are using software, you probably are going to need to go back to your vendor and figure out a little bit what the best way to get that change done is. It could be that everything gets, re-uploaded into the existing company. It could be that you need to create new legal entities or add DBAs or things like that. But when you're spitting out all those returns, if nobody's needed the company information or legal entity structures or DBA information, that's going to spit them all out wrong. And I've seen people file states and states worth of returns only to have them rejected because, obviously they're wrong. They're not filing under that company. That's not right anymore. Same thing with signatures, signature changes. So if you have a new signator because, the old person is no longer with the company or they're no longer responsible for being the signer, whether you're doing wet signatures or whether you're doing automated electronic signatures out of software, you again want to make sure that those get updated. So whoever's supposed to be doing them, everybody needs to know who's supposed to be doing it, or you need to make that change in your software before you start spitting out returns. Again, seeing people file lots of returns with the wrong signature on it. And so then, that becomes problematic if you get audited or anything like that. And then mailing addresses for notices and bills. You certainly want to highlight changes for mailing addresses to make sure you get those paper documents back. But because they're probably not going to necessarily, all the jurisdictions aren't going to just rush right in and update that, you will still see that you will be getting paper sent to the wrong address for a good long time after your merger or acquisition. So you will want some sort of mechanism in place for getting that mail to you, and also for seeing what's missing and seeing what you need to go potentially look up on the jurisdiction website or contact the jurisdiction until eventually, hopefully, everything finally comes to the right place. So those are things that, you probably need to think about in terms of the software that you may be using and how you would update, the data in the software and get it all, right with the right companies, everything under the correct company or legal entity, and then maybe, having to retire the old companies and old information in that system. So let's jump into our next poll question.
Yeah, thanks, Melissa. So this is our third of 4 CPE poll questions, and the question is, what % of your team's time is spent tracking appeals deadlines and working on appeals valuations? So more than 30% through less than 10%. So you can select one and then hit submit to answer this CPE poll question. And as a reminder, attendees need to answer 3 of the 4 poll questions and attend 50 minutes today to receive CPE credit. So we will give you all just a few more moments to answer this one. Okay, let's look at the results. So currently, it looks like most of you are not spending too much of your time in this process. So I will pass it back over to Melissa.
Sure, and that doesn't surprise me either. There's definitely a lot of companies who are barely keeping their heads up above water as it is with all of the compliance processes. And I am betting it's not because, not because you don't think that there may be opportunities for, better valuation or, things like that, but just because, often you don't have time, or maybe your property values, are lower and it's not a big deal to you. It's 10% off, it's $2 more in tax, who cares? But if it's a lot, then, it's certainly something to be looking at that, that could really impact your tax. So kind of on that note, with this merger and acquisition idea, reconciling locations, assets, cost methods, and valuation methods to avoid audit triggers. So we talked a little bit about the location listings for the current company and the target company, making sure that you're reporting all of those locations correctly, that you've been given all of the locations so that you can report them correctly. And then same thing with assets. That's our test. We all have, either spreadsheets or fixed asset systems where ideally all of that data is updated correctly. But I have heard enough horror stories from many of companies on this webinar who, the fixed asset people don't always do everything timely, or they don't always retire assets that should be retired, or, things like that. And so you're paying on things that, you don't own anymore. When you're merging or acquiring a company, how are you reporting costs? There are some people out there who, report based on original costs, but you might be reporting based on manufacturing costs. You might be, reporting based on your purchase price. So if you've, acquired assets from somewhere else, maybe that weren't brand new, the price that you purchased them for is maybe different than the original cost. So what cost basis are you using? Because if you suddenly jump from one to another and that cost difference is noticeable, that can be a big audit trigger. So I've seen that happen before where, somebody imported data into the system from another company that was using a totally different cost method, and all of a sudden the cost significantly dropped because obviously the purchase price and the original costs are typically going to be very different, especially on expensive assets. And so the assessor was like, that seems odd that the cost you reported last year and the cost that is this year is totally different. And it triggered an audit, and those people, had to spend a lot of time kind of digging out of that hole and, making an agreement with the assessor as far as how to report that. And similarly, valuation. So, most of you guys, if you're not using a software, you may or may not be depreciating your assets in states where they don't require that you report any sort of, market value or anything. Many people that use property tax software, that software calculates it automatically. So typically you do have some sort of, mechanism for doing that pretty easily. But again, the company that you're acquiring may not. Or if you're being acquired, but they're going to be using your software, bringing their data into your system, then how you're doing it may be the new standard. So it's just a matter of verifying how that's been done and kind of how people have classified that. Because again, we've seen companies where they were trying to depreciate everything on a 5-year life, and the same industry, the other company was depreciating it on a 20-year life. Obviously, there's a huge difference in valuation when you bring that in and just hit the calculate button, and all of a sudden the values are just completely off. So that can also, be kind of an audit trigger for an assessor if they're looking carefully at it. So making sure all those locations are accounted for, close out locations that no longer exist, file those 0 returns and communicate to the assessor. Do the ERP audit of target company assets to make sure how they're doing that. Are they combining assets? Do they have things in their assets that shouldn't be there in certain states, like software or sales tax? Are there thresholds? We talked to one company who had combined assets. And so, each asset represented 100, shopping carts or 100 computers. And so combined, it was, thousands and thousands of dollars. But when somebody else took them over and they were like, wait a minute, this is like 100 different assets, and each one of these assets individually doesn't meet the threshold of reporting, then they were able to, dramatically reduce what they were reporting, because really it was only reported that way because it showed up as one line item. So, there's lots of little things like that that can come into play. And if you're really careful as, property tax department, you can sometimes get some wins out of that. But if you're not sure what to do, or if you can do that, again, it's a good idea to talk to a consultant. Cost method, we've talked about just how people are bringing in that cost and reporting that cost, and changing it up dramatically is certainly going to raise an assessor's eyebrows if they don't see why that might have happened, especially if you're reporting, under the name of the old legal entity and they're comparing it to last year's return, and the costs are significantly different for what are the same assets. That's, a big deal. And then again, could be happening differently between the, acquiring company and the target company. So those are all things that you just want to make sure that you have all in line, you have everything kind of squared away. And the easiest way to do that certainly is having some sort of software system that can do those kinds of comparisons. So all of the data that we're looking at here, when we think about how that works with, manually extracting data or having data stuck in your ERP system, everything here is, things that you're getting from different sources, but there's also stuff that's been done or stored internally that you need to know about. So when you're looking at filing returns, managing assessments, protesting your values, if you're doing that, processing bills, and then building your budget for the next year, you're also looking at, mailing systems versus electronic. So do you need to have some sort of, whatever your process is currently as far as mailing versus, sending things via email or using, county websites, audits, handouts, ERP systems. Those kinds of things are certainly going to come into play when we're talking about these topics. So where your data is, where you're getting it from these, the target company, that's something that's really, it takes a lot of time, and it saves a lot of time, that your source of truth is true, because that's really the thing, is that if you don't feel like you can trust your fixed asset system, or you don't want to rely on spreadsheets that are being sent from different locations, or if you're a consulting firm that's helping people, hoping that you're going to get data from your clients in time, all of that is definitely challenging. So you're getting some of this information from jurisdictions sending it timely, who may not be sending it at all. You need to be able to track that down. And then, whatever systems that you have in place are going to be, you want to have that one source of truth. So that's where, again, I think, a property tax software application is a good idea. And it's going to help you really get your hands around everything. So many companies that are siloed are still using two different systems. It's really hard for anybody, like a director of tax, a VP of tax, a tax manager, to see everything holistically when you're cobbling it together that way. And so just thinking about your time and effort and the time and effort of your staff to how much is the cost of automating versus how much time are you guys spending on things that could be done for you that then could free you up to do other more important things. Or if you've lost staff and they haven't been replaced, unfortunately, sometimes that does happen, but the cost of some of this automation could be less than another headcount, and it's still better than struggling along to do what that person was doing without that person. So thinking about minimizing that cost of replacement. Last thing, reviewing valuation post-reporting. So if you want to identify appeal opportunities or flags, again, most systems are going to compare what you rendered on the return with what the notice value was. Is it in line? Is it what you would expect? Do you have the potential for a lot of tax savings? And not really. Sometimes there's a big value difference, but with the tax rate, it's really not going to make that much difference on your tax bill. Other times it's going to be a very significant difference, and you're like, wait, what the heck happened here between this year and last year? Sometimes it's a mistake that the assessor made. Maybe they didn't take off, assets that you marked as disposed. Sometimes it's, they've changed their, tax rates and assessment rates in their jurisdiction, or they just want to value your property differently than you've depreciated it. So thinking about whether it's worth it and using an easy solution to see if it's worth it to, potentially protest is, not a bad thing. Planning for existing audits. If you have audits or if you know that you're going to be audited, some states like California audits every 3 years, so you know what's going to happen. So if you know it's coming up, you want to be aware that that might be something else that's coming up within, the time frame of a merger or acquisition. How are you going to account for the resources that are going to be needed? What kind of data do you need to provide for that audit? And how are you easily going to get it out when you already have so much to do? And transitioning any open appeals. If you do have open appeals and the target company has open appeals, who is going to take that on? Who is going to see it through? What's going to happen with that? It doesn't sound like many of you are, into, high dollar litigation. I know some of your, the consulting firms probably are on behalf of clients. But if you're not doing a whole lot of appeals, that may not be as worrisome to you. But if you are in the middle of something, then, you don't want it to slip because you changed, or now all of a sudden it's a different company name. So like the whole thing has to be started over, but oh no, you've missed the window. So, just knowing what's going on with the tax team at the time of a merger or acquisition can be really important and really helpful. The last thing I would touch on with this too is that, one thing that I see a lot of in terms of, solutions, technology is nobody talks to IT during the decision to merge or acquire a company. And so IT is another area that kind of gets some short shrift here. But you guys know, as a tax department, whether you're using a property tax application, you're using a fixed asset system, you're using some sort of AP system, there's definitely different software and software vendors that you're working with. And so that is a great time to sort of loop IT in, because it may be making decisions between, are you going to keep the software that you have? Or are you going to use what the target company has? Are you going to, fold them into one system? Is there a way now to connect into your AP system or your ERP system that may be better than, what you were doing before, what they were doing before? So it can be a good time to really examine some of those processes and some of those opportunities for automation, because sometimes, people buy a software and they don't know that it can connect to AP, or they don't know that there's an easy way to make those two talk to each other, but IT probably does. So it's not a bad thing at all to have those conversations with IT as part of that merger acquisition, not only decision, but process, to see what then can be improved in terms of processes and automation during that time. So just to touch on, Avalara property tax, we talked a little bit about tax solutions and whatever property tax application you may be using. There are a lot of you that said that you were kind of just doing things manually. And so it may be worth exploring, or I think it is worth exploring, because you don't know until you know what's out there, that there are opportunities for, automating some of these processes, whether it's during a merger or acquisition or not. But certainly if you are undergoing one, it's going to be a lot easier to transition if you have some sort of solution in place. So, the accuracy of your data, making sure that, the softwares are going to help you ensure the accuracy of your data, make sure you're using the right forms, that you don't have to go looking for all the forms, you're not picking the wrong form to file, and also providing those due dates for you for the returns, for when you should be expecting notices, for appeal deadlines, and certainly for bills. Costs being making sure that you're not overpaying tax, that you're not being overvalued, that you're not getting penalties because you missed something, that the software is clearly going to show you, you have these 5 accounts, you probably need to go look at them because the bills are missing. The volume, doing anything by hand or doing anything, one at a time is certainly going to be a lot more tedious and time consuming than being able to generate, the whole state at once out of a software. And unexpected increases, if you do a merger or acquisition, you could be doubling or tripling the amount of work that you have. And how are you going to do that with the same amount of people unless you're automating? And then appeals, we've talked about that, just making sure that, you're not being overvalued. So with the property tax solution, being able to automate and generate those returns, you want to be able to have, a SaaS-based solution that is central, that is web-based, that is backed up. The data is going to be there. Nobody can delete it off share drive, all those kinds of things. Having all those dates provided, jurisdictions provided, comparisons and reporting provided, APIs to connect to, AP or to do reports for Power BI, things like that. Those are all going to be things that are going to free you guys up to do more with the people that you have, because nobody's overstaffed these days, right? So again, generating all of those returns, tracking all of the values, bills, accounts, document extraction, instead of keying things, just uploading documents and letting the system extract all the data and import it in for you. It's all going to be great time savers, and it's going to allow you to really see what you have and make sure that you're not missing anything as you do bring this, target company into your fold.
Okay, thank you, Melissa. This is our 4th and final CPE poll question that is up on your screen now. Would you like to speak with an Avalara sales rep about what you heard today, yes or no? So if you select yes, we will try and follow up with you within the next week or so to see what questions you have. But for now, we can answer questions you have about the presentation or property tax. So if you have any questions, you can drop them in the Ask a Question box, and we can get to a few of them in the remaining 5 minutes or so. So Melissa, first question, can you go over the recent Wisconsin property tax change as it relates to exemptions?
My understanding is that Wisconsin no longer requires personal property tax filing at all. So it's not really specifically an exemption change. It's really just a matter of, they had their website, you had to go in there and type your data into there, and then they decided that that was no longer necessary. So my understanding is that Wisconsin has dropped their personal property tax filing requirement. And certainly if anyone's interested, I think I have a link to the article or the blog post that we did that I can send. But that was what the information that we received, and I think was out there as far as Wisconsin just changing that requirement.
Okay. Next question, are there any different property tax to-dos during a consolidation? Are there significant differences between consolidation and M&A to-dos?
I'm going to say the answer is that depends. And the reason I'm going to say it depends is because it depends on where your data sources are right now. So, some companies that we've seen in terms of a consolidation, and the reason that we see it is because as a software vendor, and I've worked with, several of the property tax software products out there on the market, so I'm pretty familiar with them and with most of the companies that use them, is that if all of the data is housed in one software, then there's no differences. There's just some, cleanup to do a little bit. I know most of the vendors that are out there that do property tax software, and I would always recommend not only going back to your vendor during these kinds of times, there's always going to be somebody in support or somebody, in the software space that you can go back to and say, hey, this is going on and we don't want to miss anything. Can you guys walk us through what you've seen? Because it could be like, oh yeah, people always forget to go into here and uncheck that box, or people always forget to update this, and then, that all spits out on the returns wrong. So we can certainly help you with those kinds of specific questions if it's, something that you're using an application for consolidations. But if you're talking about consolidating, but all of your data is coming in dribs and drabs from different sources, then I would say that all of those same things apply. Why it depends, because if you have one holistic system with all of the data in it, that's a lot easier to, just tweak any changes during a consolidation situation versus, I just talked to one company yesterday who has, they file in 7 different states, and each state has one person filing completely separately off the reservation, not in any sort of, consolidated software. They're going to start doing that, which is why I was talking to them. But nobody, like the right hand doesn't know what the left hand is doing, and the tax director has no idea what anyone's doing. Like he's just getting all these individual returns and has no idea where the data is coming from. So yeah, I would say those to-dos are certainly going to be applicable if you're going to try to put all that together, coming from 7 different sources and figuring out, do you need all 7 people to be doing returns, or could one person just generate them all from one system?
Great. Thank you, Melissa. And that's all the time we have for Q&A. So, Melissa, thank you so much for presenting today and going over all this information. Very thorough and very informative. Was there any final word you wanted to say before I close out today?
No, I just want to thank everyone for coming. And if I did not get to your question, I am on LinkedIn. So if you want to private message me on LinkedIn your question, I'm happy to get back to you. Sorry, we ran out of time, but I'm happy to answer anything. So definitely don't hesitate to email me or reach out on LinkedIn.
Great.
And yes, we can answer all the questions. I'm looking at them in the chat right now.
Yes. So just to close out quickly, if you qualified for CPE credit, you can download that certificate now in the CPE engagement tool. You will also get your certificate in a post-event email if you don't get a chance to download it right now. In that post-event email, we'll also include a link back to the recording and the slide deck and the additional resources so you can access all of those again. And then if you missed this in the beginning, just a quick reminder that Avalara's signature customer event, Crush, is coming to Austin this November. We would love to see as many customers as possible there. We'll have a lot of opportunities for sessions, thought leadership, networking, so you can check it out at avalaracrush.com. So thank you all again for spending your time with us today, and thanks to Melissa, and this concludes our webinar.